In this session, I want to show you a very simple profitability framework that you can use to have a glance at any business, almost like you would do like with a multiplication table, which comes to you as as something very intuitive and which you don't have to think much about. You can use this profitability framework and model to actually analyze any business very, very quickly, to get to the point in which you understand fast what may be some of the problems of that business, and from there structure your hypothesis and deep dive into your business or someone else's business. Now, you know that at fundamental level, a business is made of two main components like revenues and cost. And if you take costs from revenues, that's how you get either profit or losses. So a company can either generate profits or lose money. Now, before we get to it, you need to understand, of course, that the net profit or net loss will be made, as we saw, from revenue and cost. But what makes up revenue in the first place? Revenues can be comprised of the price per unit and the units sold, right? So you sell a good or an item that is going to be like, let's say, $5, and you're gonna sell like 100 units. That's how you make, $500 your revenue here. On the other side, when it comes to cost, instead you need to understand that you can have variable cost and fixed cost. When it comes to variable cost, you want to understand here the cost per unit and the units produced. So in other words, this is going to be connected to this. So the more, for instance, items I may produce, the lower it may be my cost per unit, as I take advantage of, let's say, economies of scale. And so I can produce more units at a lower cost and make more money here. However, I might increase a little bit my fixed cost. But on the other side, how do I assess whether a business has a problem or not? Imagine the case of a company who is losing money, right? So we're starting from a scenario where the company is losing money. Now we look at the company revenues and we ask, okay, how is the company making money? So what's the price per unit? How much are the units sold? And we realize that, for instance, the units sold were this year a little bit more than the last year, and also the price per unit was actually increased. So we made more money. And so we understand that the problem is not in the revenue. It may be therefore in the cost, right? So if the problem is in the cost, we go and we identify whether this was a problem given by the fact that, for instance, there was an improvement, an increase in raw materials that we used within our product, and therefore we understand that the main problem is in the cost structure. So we need to take some measures there. For instance, we might want to change supplier, or we want to diversify our supplier portfolio so that we can reach the point where this is not going to cost as much. Now let's take the opposite scenario, where we understand that instead we got a net loss this year. Actually, our net profits reduced, but it's not a problem of cost. So we understand that actually the cost more or less stayed the same on an incremental basis compared to the previous year. Instead, there is something with the revenue which went wrong. Now we look at the revenue breakdown, we see how the company makes money, the various revenue streams and segments. We look at the price per unit and the units sold, and for instance, we realize that actually this year, for some reason, even though the cost stayed the same, actually we sold less of the volume. And therefore, as we sold less, we also decreased our capacity and increased again the cost per unit. But the main cause of this increased cost actually was due to the reduced volume that we sold, and so our reduced supply. So it was a structural problem that was not coming from the cost structure, but from the revenue segment of the company. If this is the problem, then I can actually understand what's my customer base, who are the customers within the customer base, and what changed in terms of contractual agreements, or for instance, if we lost some important customers. So in other words, I can get to the problem that I'm facing right now, understanding the cause and the effect of that problem by using this very simple profitability framework. And again, this is not to say that with this profitability framework you can understand a problem right on, but it's going to give you some glimpses of the issues and some hypotheses that you can structure around what's going on. And that's how you can take fast actions, or actually you can diagnose what's going on with the business very quickly. This is a sort of consulting approach to business that you can use to actually have a glance at any business outside in the wild.